You're listening to The Builder's Mindset with Mike DiGiovanni, presented by Amazing Mindsets. Now that I got your attention, welcome back to The Builder's Mindset. Today, we're going to dive into the Q2 2025 earnings across the top public home builders. As we said before, it takes a little while to get that all put together and put out. And as well, typically for most of the builders, Q2 ends the end of June. They got to put their numbers together, and we start to see all of the earnings reports come out late July, August. And if you haven't got your copy, we'll put the link in the show notes so you can join the community, but everybody's in the community. Every quarter, we send out an earnings summary with a recap of all the builders, and we want to share that with you. So get on the list, get that going, and we're going to give you a little sneak peek too, because we're getting on that time frame where some of those early reporters, Toll, KHAV, and then right behind that, Lennar and KB, for their next quarters are starting to come. But now, on paper, the numbers are telling one story, but underneath, there is a much more deeper and important narrative. Yes, there are affordability pressures. Yes, there is shifting buyer behavior, and there are very real questions of how builders will balance margins with volume going into the back half of this year. And then, of course, would not be enough without the White House wrangling with the Fed to create that topic of rates. It's like we can't seem to get away from that topic of rates, which is kind of playing into things a little bit. And we might touch on that as well, too. And let me tell you, what's playing out isn't just about percentages in the numbers or earnings per share misses. It's about strategy, as we always talk about here at the Builder's Mindset. Who's playing defense, who's quietly or not so quietly on offense, and who's at risk at running out of room to maneuver. So, without further time wasted, let's get into it. The big picture. Across the board, we saw shrinking backlogs and a definite earnings per share compression. Affordability tends to be the tied word for Fed rates in terms of that most used terminology in the home building industry. But affordability continues to squeeze demand. And even though rates have eased, buyers are still sensitive. Builders are walking that tightrope, incentives too heavy, and margins crumble. We've already started to see that happen. Hold pricing too firm, and orders stall, some more than others. So we have seen margins crumble, and we have seen orders stall. That's why we go back to who's playing defense, who's playing offense, what are we doing? The good news, liquidity for the most part for all builders is still strong. They have a balance sheet and cash to weather the storm, move, maneuver. If land prices come down, they have capital to deploy. They have very disciplined balance sheets. Most are showing prudence in debt management. This means they have options. They can give away incentives and continue to do, which we expect them to do here. That is our belief that builders will continue, at least the bigs with the cash, will continue to buy mortgage rates down to about 5% on average. And they have options on land. If prices come down, they can execute quickly. But make no mistake, the era of easy margin is behind us, and the next phase, as it always is about execution. Excuse me, let's talk about rates just for a moment, okay? A lot of talk about rates, and yes, we'll go into some of the other things that are popping up in the headlines, but generally speaking, I believe everybody is predicting a rate drop in September. Will it be a quarter? Will it be a half? I am 99.9% confident it will not be the reduction that the president would like to see. I'm on the fence as to whether it will be a quarter or a half. If you put a gun to my head and told me I had to place a bet, I'd put it on a quarter. because I think the Fed is going to hedge their bets. They're trying to land the plane softly. And with a quarter, they say, hey, we're doing something, but we're not kowtowing to the president. And that's what I think is going to happen. But why do I bring that up? Because I've mentioned recently on a comment that I put on a John Burns post is that while the Toll earnings report had a quote from the CEO, I believe, that basically said every rate reduction brings more buyers off the sideline, something to that effect. I'm paraphrasing. I will continue to hold firm in my belief that because we talked about margins crumbling, every rate reduction is a perception and not a reality as to actual mortgage rate reduction per se. What do I mean by that? If you are a large builder and you've had the money and you have been buying rates down to 5%, give or take, rates are now hovering at about 6.5%. First off, it is not a guarantee that if the Fed lowers rates, that mortgage rates will come down. Actually, though, mortgage rates are ticking down. I think that's a little bit more about concern of the overall economy and actual mortgages being taken out. I think supply and demand is starting to hit the mortgage industry a little bit harder. If you want to lend more money, you got to get a little more competitive. But if mortgage rates are 6.5%, and I'm already paying $30,000, $40,000, $50,000 to buy those down to 5%, and mortgage rates even go, let's say, to 6%. Let's say he drops rates 0.5%, and the mortgage rates track that, and they go to 6. I'm already buying them down to 5. We talked about crumbling margins. Now I have a choice. Do you think I'm going to keep spending the same amount of money roughly to buy rates down to 4.5? Or am I going to take that savings, because now I only have to buy it down a point as opposed to 1.5, and put it in my pocket and boost my margins? That's the balancing act that even the bigs have to do. And I think they're going to put the money in their pocket because mortgage rates have been above 6% for 3 years now. And they're selling homes, albeit not as fast as they would like. But I think they need to really balance price, pace, rates, margin, all of that. And it'll be interesting to see. And as we've said before, just watch Lennar, because whatever Lennar does, all the other bigs are going to have to do. So if what I am saying, Lennar does something different, trust Lennar, not me, because everybody will follow Lennar. I'm not as smart as the Empire. So with that said, we have, like I said, across the board, shrinking backlogs. This is a big thing. So the good news with liquidity being strong for the big builders, they've got these options. They can do what they want to do. What I do think, though, back to interest rates, is I do believe interest rates, if they translate to a reduction in 30-year fixed rate conventional mortgages, this is who will benefit. Smaller builders who have not been able to either afford to buy those rates down, or buy them as far, they may continue to spend the same amount of money and get their rates down a little bit further. So let's say you're a builder, you've been buying rates down, let's say to 5.5%, and rates go down 0.5. Maybe now you'll buy them down to 5 to be a little bit more competitive with the publics, okay? And depending upon the market you're in, that might turn the hand of Lennar. And here's the other thing Lennar is really good about. Lennar has a data machine that can look at things on a division by division, market by market, community by community basis. So if you're a smaller builder competing in a market with a heavy market share, decent market share compared with Lennar, you start to buy your rates down a little bit more because you haven't in the past. Lennar could just basically do the same in that market specifically just to compete with you. So it'll be interesting. And this is going to play out at the local level for sure. And then the others who are going to benefit, and this could be a problem for new homes in general, rates come down. That takes some pressure off of the existing home market stock. If we start to see more homes come on the market and more homes transact in the existing resale market, that could put a little bit of downward pressure on the overall demand for new homes, okay? A lot of people like to buy homes in existing neighborhoods. They don't want to buy a new home. It's not because they don't like new homes, but new homes tend to be further out in the periphery of the suburban markets. Some people want to be closer in, more established. And so that could translate. Actually, lower rates on 30-year mortgages will translate into better sales for existing homes, which could increase inventory because more people will enter that sales market. and that will put some pressure on new homes. How much? We don't know. Depends on the rates, okay? And this is a fluid market. It's a moving market because we could tend to, who knows? Rates could come down. We don't know. We just know they're going to come down in September. We're pretty confident of that. We don't know what's going to happen at the next Fed meeting and the one after that and the one after that. So, all right, rapid fire company highlights. Let's dive right in. Lennar and D.R. Horton, they are proving that scale matters. Orders and deliveries are strong. Both are dealing with margin compression and ASP declines, average sales price, but that's to be expected. Lennar's 12% reduction in cycle time is a weapon that they are utilizing. Once again, though, efficiency equals resilience for both of these teams. Both of these companies are leveraging their scale, and they're going to do everything they can to continue to leverage that scale. Lennar has been very, very outspoken about saying nationally they will keep pace. They will reduce margins and reduce pricing to do what they need to do to keep pace, and they believe that maintaining their volume rather than slowing up will pay off for them in the long run. Pulte, still holding one of the best gross margins in the industry, let alone the group at 27%, but they are showing signs of volume softness, particularly in the West and Texas. It's cutting into their earnings per share. They're leaning on balanced product mix between move-up, active adult, and entry level to keep their momentum. Meritage and KB Homes. So now we're talking number 5 and number 6. Meritage showed strong absorption, but is watching backlog erosion closely. Nothing that not every other builder is seeing. And I think it's less of a concern, in my opinion, for Meritage, because as they move forward more to this quicker close, first it was we're not going to list homes till drywall. Now they've got this 60-day sale to close guarantee. If you start selling homes closer to your completion and close window, your backlog is just naturally going to get smaller. And so, yes, their backlog is shrinking, but that's also indicative not just of the market, but also indicative of their strategy change. So KB continues to benefit from their build to order model. It's helping their customer satisfaction. It's helping their margins. Their SG&A pressure is creeping in on their spec homes. As a builder like that, even though you have a build to order focus, you're always going to have some specs. That's posing some problems for them, but nothing that I'm overly alarmed about right now. Toll, luxury demand is steady. This is a little bit of a preliminary, right? Luxury demand is steady, but incentives are rising. Their backlog dropped nearly 40%. That's no small number. They did execute share buybacks. This signals confidence, but the question is, can luxury sustain if affordability continues bleeding into the higher tiers? MI Homes and Dream Finders Homes both saw record deliveries, but also significant backlog erosion. Are you hearing a theme? Backlog erosion. Yes, it's a problem, but there are opportunities with the backlog erosion. Let's be clear about that. Cancellations are ticking up. That's also a pattern we're seeing across the board. Dream Finders is still running with a land-light strategy, which gives them flexibility, but their margins did take a hit. LGI Homes. Interesting outlier. They had not such a great quarter last quarter, but they were able to hold profitability even with the 20% drop in closings. Cancellation rates north of 30%. They are typically high, but that's high on the high end for them even. That's a flashing yellow light. TriPoint, Beazer, KHOV, all three are battling absorption declines, as everyone is. Incentive pressure, impairments. The middle tier, this is what we're starting to see if you look at it, the middle tier of the large builders is getting squeezed the hardest. They're a bit too big to be flexible and nimble, but they're not big enough to wield like a Lennar or a Horton strategy leverage. So it'll be interesting to watch how those mid-tier larger builders produce over the next few quarters. Green Brick, quietly a margin machine, 9 straight quarters above 30% gross margin. Their self-development model for land is giving them insulation that others envy. So that's another avenue for smaller builders. If you have good land strategy, good land connections, good land development, this is a way I think for smaller builders to leverage, use those relationships to keep those land holdings close to the vest, and use those both as leverage to increase your home builder margin, as well as partnering up with some of the big guys to get good cost of capital to develop that land, and then also create some deals where you control that land, maybe doing some master plan communities in your market, selling off to larger builders who you know can afford to pay a little bit more for land because they have scale on their direct construction costs. So look at Green Brick. If you're curious as a smaller builder, I know Green Brick is a public, but if you really look at, let's see, they're let's say, they're 3, 4, 5,000 closings a year kind of builder. So if you're a builder doing, 5 to 2,000, you're private, look at what they do. You can learn a lot from them. Now, let's step back for a minute. This isn't just an earnings report, okay? This is a psychology test for both builders and buyers. What do we mean by that? For builders, are you chasing the quick win with incentives and ASP cuts? Or do you double down on efficiency and discipline? You know our belief here. You should be doubling down on efficiency and discipline no matter what. Whether you decide to continue to lean into incentives and ASP cuts or not, you should still be doubling down on efficiency and discipline. For buyers, do you act now under the fear that rates don't go down as much as you hope? And maybe if they do prices start to go up, as what typically happens? Or do you wait and hope that rates come down slowly and prices stay steady? It's kind of do you jump in now or do you wait? So it's always another waiting game because what's going to happen? And as I mentioned before, I don't believe the large publics are going to buy rates down lower than they are right now anyway. So the question becomes, in my mind, if you're a buyer, is if the Fed drops rates a 0.5 point, do we potentially start to see prices tick up because there's a perception that that's what's supposed to happen? But then if you go to a new home community, you're still at best going to get 5%, and now the prices are up a little bit more. So here's my advice. If you want to buy a home, you need to buy a home, go buy a home. If you can live in a home for 5 years, go buy a home, okay? So, you never know what's going to happen, but if you need a home, buy a home. Like I said, I think if you can say, I'm going to live in this house for 5 years, it's a good investment, in my opinion. The truth, confidence drives markets more than numbers. Firmly believe this. And now confidence is a little uneven. Some builders like Lennar with cycle times or Green Brick with margins, they're giving investors and buyers reason to believe. Others are signaling hesitation. Let's talk briefly about some of the White House data that they recently shared, right? Earlier this month, or actually mid last month, the CPI report revealed that inflation beat market expectations once again and remains stable, underscoring President Trump's commitment to lower costs for American families and businesses. The Panicans, that's a new one, continue to be proven wrong by the data. President Trump's tariffs are raking in billions of dollars. Small business optimism is at a 5-month high, and real wages are rising. The American people have rightfully put their trust in the president. I'm not going to go too far into that. You believe what you believe, but the truth is in the data that inflation is tracking at what they're saying since he took office at about 1.9%. It is definitely stabilized. I don't think anybody's disagreeing with that. Real wages are up 1.3%. Prices are down, generally speaking, across the board on different products. Some things are up, yes, they are, but a lot of things are down. And real wages are coming up. So I do sense that there is, whether you truly believe this data, is you put that on top of steady unemployment rates. I know there was the July finagle, whatever you want to call it, and the unemployment, like the revised numbers, which somebody one day will tell me, why do we always put out numbers and then we revise them a month later? Why don't we just put the numbers out 2 months after? The August, it's like July numbers come out and then a month later, and they come out like I think early August, and then it's 2 weeks later they revise it through. Say, well, why not just get it right and put it out? But whatever, for all we talk about that. Right now, unemployment is like 4.2% nationally. It's not bad. That's actually pretty solid. Some people would call that full employment. I believe they say anything less than 5% is considered full employment. When you look at how people feel right now, I generally feel, when I talk to people and when I look at the numbers, there is a good amount to be relatively cautiously optimistic with a little bit of a penchant for optimism. Unemployment is relatively low. Inflation seems to be in check. Real wages are rising. There is a ton, we're talking about trillions of dollars of investment coming back in the United States, which can do nothing but, in my opinion, but benefit the overall economy. So you put all that together and, what do you got? You combine that with the liquidity strength of the larger builders. They all have strong balance sheets. So they've got this moat around them to protect what they've built. Backlog is a reality. Erosion here is the trusted forward indicator. Watch it closely. Why did I say earlier, though, that backlog erosion might not be the end of the world? In the event that the market starts to stabilize and so show some strength or real stability on the pace of sales and price of sales, and interest rates come down enough to create the perception to prop that up a little bit, and then you also combine that with their ability to maybe start finally renegotiating some contracts, whether it's for direct costs, whether it's contracts for land development costs, or whether it's even land itself, because we're talking about and hearing the mumblings that land prices should come down. Having a relatively moderate backlog might not be the end of the world, because when you reload that pipeline of the backlog, it's going to most likely be more in your favor of overall margins than what you have right now. So not the end of the world. They'll just have to work through their SG&A, which is going to take a little bit of a hit, because it's going to take them a little bit more SG&A money to because their cancellation rates are popping up. So, look, margins are the scoreboard. Incentives are still unavoidable. I think that's the foreseeable future. I think we're looking through 2026 that builders will continue to incentivize in some way, shape, or form, but discipline will separate the leaders from the laggards. Look, margins, let's be honest. Like I said, if you don't get the report, sign up for it. If nothing else, just to look at the general aspect of 18 public home builders left, because Land C is out of the mix now. 13 of the 18 public home builders have margins of 20% or higher still. With everything that's going on, they still have margins of 20% or higher. Let's look at another quick number. 1, 2, 3, 4, 5, 6. 6 of them have margins, have net income after tax of over 10%. And things are looking okay right now for the home builders' margins in general. This is not a bad place to be, considering everything that's going on in the market. There are a lot of regional dynamics that matter. The West is finally showing some signs of softening, while the Southeast entry level continues to perform. They do have, particularly in Florida, to work through some inventory still in Texas, but I think they're getting there. So the question becomes, to win in this market, it's a lot about who adapts faster and who's able to reposition and then execute. The builders who can pivot product mix, reduce build times, and maintain pricing discipline will win in the second half of 2025. So listen, that's almost a wrap. That's what we got. That's what we see. Be disciplined. When we say pivot, don't pivot every 3 months, okay? We're saying if you need to pivot, look at what you got in front of you, pick a strategy or two that you're going to execute on, and pivot to that as quickly as you can, and then stay disciplined. Numbers aside, remember, the market rewards discipline and clarity and punishes confusion and change and just the inability to stay focused. Builders that know who they are and who they serve win. Do you have faith and conviction in your strategy? Ask in faith with no doubting, for the one who doubts is like a wave of the sea that is driven and tossed by the wind. Don't let that be your story. Thank you again for listening. We hope you enjoyed this episode. Oh, and before we sign off, just a little tidbit. We talked a little bit about Toll, but we've only scratched the surface. The luxury segment is starting to show some cracks. Toll is the perfect case study. We'll talk about that. Backlog is down, as we mentioned, nearly 40%. Incentives are creeping higher. They are signaling confidence with buybacks. In the next episode, we'll talk, is this resilience or overconfidence? And then there's KHAV, the long underdog. They're staring down the same affordability absorption headwinds as their peers, but without the same scale or balance sheet strength. How they maneuver in the months ahead could be a bellwether for the entire mid-tier. They'll be ones that we want to watch. I will give them credit because as we talk about staying disciplined, they are, and they've made it public. They said they're going to focus on pace rather than price, and they're continuing to do that. So props to them for staying disciplined and focused and consistent in that direction. Stay tuned. We'll unpack both of these stories in depth in the next episode. Trust me, you won't want to miss where the numbers and the psychology is pointing next. We'll see you then. Have an amazing day.
You're listening to The Builder's Mindset with Mike DiGiovanni, presented by Amazing Mindsets.